The U.S. economy added a solid 223,000 jobs last month, coming in above expectations. The unemployment rate also fell to 3.5%, matching a 5-decade low. This caps off a strong year for the labor market, which saw jobs numbers bounce back to pre-pandemic levels. Let's bring in Bank of America's chief economist, Michael Gapen. Michael, what do these numbers tell you about the state of the labor market?
Well, thank you for having me on. I think the numbers tell us that the labor market is still quite hot. The unemployment rate number that you mentioned is the lowest we've seen since 1968. So it's about a 5-decade low. 223,000 jobs added in the month of December. That pace has come down, but that's a robust number in any normal expansion. So I think job seekers right now are probably still meeting with a lot of success, and I think labor demand remains exceptionally strong.
So if the labor market is so hot, do you expect that the Federal Reserve will have to take more action?
We do, and I think the Fed has made that clear. So 225,000 jobs or so per month is about twice as much job growth as I think the Fed would like to see. The Fed thinks the labor market is extremely hot or too hot for the inflation side of its mandate. So I think it wants to bring employment growth down even more, probably to about 100,000 jobs per month or less. So I do think that means the Fed will look to raise its interest rates at the February meeting, we think by another 50 basis points, and probably push its policy rate above 5% early this year.
So let's take that a step further. The Federal Reserve Chair wants to see inflation at 2%. How long will that take to get there, and what will it take to get there?
Yeah, that's a great question. Most of us in the kind of the economics forecasting world think that that's probably a 2 to 3 year path, that we're probably past peak inflation right now in terms of year-on-year rates of inflation. Those should start coming down more clearly over the course of 2023. But it'll probably take 2 years, if not 3 years, to get inflation back down to the Fed's desired 2% level. So we're moving in the right direction, but I think we have a lot more work to do.
Well, that's a significant period of time, 2 to 3 years. So what are your expectations of a recession in 2023?
Yeah, we're of the view that the U.S. is, I think, more likely than not to experience some sort of mild recession in 2023. We say mild in terms of the downturn that we would expect relative to past historical averages. I think the view is the unemployment rate should rise from its 3.5% level, maybe to 4.5%, 5%, maybe a little above. And while that's a big move from where we are today, the average unemployment rate over the last 20 to 25 years is about 6%. So we do think the U.S. is more likely than not to at least have a short and relatively shallow recession in 2023.
So what's your advice to consumers with rising rates and persistently high inflation?
Yeah, I think our message here would be that, I think the term in 2023 is probably going to be some belt tightening. I think households are going to find that their employers are doing that there's more emphasis now on cost control than there was previously, and I think households should probably do the same. And so I think the average household may see some of its pandemic level savings have dissipated and say, hey, maybe we need to cut back on expenditures a bit, push the savings rate higher, and engage in some belt tightening.
Michael Gapen, thank you.
Thank you.